Podcast is now starting. All attendees are in listen.
All right. This is being recorded, you guys. One thing I say at the beginning of all these, it's not going to come out like right away after the webinar, but watch this again as soon as we send this out to you guys, because some of the nuances will fly by you the first time, and then the second time through is really going to make this sink in. And I know you can go online and figure out how to do a long put spread. It's not very hard, right? But I am going to have certain rules around doing a long put spread to increase your probabilities of success. It is a low probability strategy. Anytime you're doing an option strategy for a debit, you are lowering your probabilities because, you've all heard it before, risk equals reward. And with very little risk, that means there's very little reward. So with this put spread, we add a little bit more risk with it in the form of the amount of debit we're paying to increase our probabilities of success. So that being said, watch this again, because even if you've been a veteran trader and you've traded options and you know how to do a long put spread, it's likely you haven't heard my rules in and around a long put spread. So therefore, it's going to be able to be something that even a veteran trader will have takeaways from. And then I'm going to also try and make it a little bit easier for a person who hasn't traded options before. So for some of you veteran traders, some of this is going to be a bit of review. And for you newer traders, you'll have a lot to take away from this. And hopefully won't have to go through the pains that these other veteran traders and I have had to go through in doing the put spread wrong. So let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. For my commentary on everything from economic to geopolitical and market analysis, I've been trading my own money for well over 20 years now. It's probably almost 26 years now. And I started trading in college with some money I'd earned and a psychology degree, which I still to this day probably say is more beneficial to trading than even a financial degree, but switched it over to finance, not knowing any better, I guess. And upon graduating from college, moved up to Chicago, started out as a runner. The guys that run paper, like these guys, run paper into the pits, and started trading from there on out. This is all the residual paper on the floor that the brokers end up throwing out, and the runners get to go and pick up again. But in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. I mean, I've seen the fast up on the board, and they do put a big F on the board for fast when it is crazy. Any opinions, news, research, and analysis, or other information or material provided by Pro Trader Strategies and associated companies is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically, and I take this to heart, you guys, I really cannot give you guys investment advice. I can't say that, hey, this put spread, everybody should be doing it, because I don't know your risk parameters. I don't know what's in your portfolios, and that's why I'm not going to give you a specific stock to say, hey, go put this in your portfolio, because it could overweight you in a certain aspect, or it could be counterintuitive to what you're already doing. So basically take what we're teaching you in these webinars and daily market commentaries and implement it into your portfolios in your own way. So do your own homework. Please remember the past performance of any trading system or methodology is not necessarily indicative of future results. Trevor, I think it's like 50 degrees here. It could be 70, but it feels like 50. All right, so you guys can follow me on Twitter at Wolfman's blog, or you can follow our parent company at Pro Trader Strat. Pro Trader Strat will give out market wisdom and some deals here and there, and I will give out snark and hopefully some market wisdom. All right, so like I said, this is on the long put spread. I'm going to briefly go over this really quickly. I know we went over it in a little bit more detail last week, but basically what we're looking at is delta affects an options premium in relation to the underlying's first dollar move. What that means is, on the option montage, which is where all of the options pricings are, where they have all the strikes, if you will. So let me pull up one real quick and try and find one that I don't really have a position in. I have a position in all those. But let's just look at Macy's real quick, because it's right here. This is the option montage with all these different months, expiration, expiry, however you want to say it. This is the option montage. This is volume and open interest, which is very important if you're trading options to know what's going on. But this is the delta. And what that means is when Macy's goes from $25.67 to, let's just say, $24.67, so it goes down by $1, these options will all adjust in price by the delta. So if it goes down $1, these premiums will increase by the amount that the delta is indicating for that first dollar move. So for instance, if this went down from 25.67 to 24.67, these 25 puts would increase by 40 cents. So it'd be worth right around $1.30 if I'm just, $1.35, trying to go a little bit mid-market, banking on 95 cents. So an increase of 40 cents would take that to $1.35. And in that, the offer would probably be $1.41 and the bid would be $1.32. Does that make sense? So that first dollar move, and that is for the calls also, the first dollar move higher from 25.67 to 26.67, these 27 calls would increase by 37 cents. All right. So if it and vice versa, if it moved down, these would decrease by that 37 cents. And if it moved up, these 25 puts would decrease by that 40 cents. Okay. So that first dollar move, delta tells you what is going to happen. All other things being equal, right? That's in a second, if that were to happen. That's how accurate that is, probably, because you also have theta, and volatility is also going to affect those premiums, which I'll talk about here in a second. So the gamma is the rate of change of delta, and that's basically what it's saying. Gamma adds into delta for the second dollar move. Okay. All right. So that second dollar move. So when we were talking about Macy's going down $1, now let's say it's gone down $2. So from 25.67 to 23.67, these puts would have increased by that 40 cents on the first dollar move. The second dollar move, you basically take delta and gamma and add them together. So now it's 52 cents. So it went from $1.35 to adding in 50 more cents. So now we're talking about $1.86. So that second dollar move, gamma gets added into it. Okay. So if we were to move that $2 in 1 second, volatility is probably going to increase and stuff like that. But this is all other things being equal. That's how you can gauge what delta and gamma are doing. And that's just only one of the things that delta tells you. There's a plethora of other things that delta can tell you. There's like 5, 6 other things delta can tell you. And theta is the impact of time on the premium. So for every day that goes by, everything is in increments, right? So every day that goes by, all else being equal, this market the next day hasn't moved a penny. And the only thing that has happened is theta eats away. You can always think about it. Theta eats away, erodes premiums. Okay, so every day that goes by, theta is going to decrease by 2 cents. Now that changes. Tomorrow, the next 7 days to expiration, this number is going to start increasing. Okay, but this is just as of right now. Tomorrow, this premium will decay, all other things being equal, by 2 cents. And the same thing goes with the options on the call side. Every day that goes by, it's going to decrease by the theta. Okay, 2 cents there. All right, so the next one is vega, and that's volatility. A lot of these, if you look at delta is change, everybody kind of knows change on delta for the most part. Gamma, there's no real great way to do it, but think of this as theta is time, T, theta, and vega is volatility, vega. So is a measure of change in volatility. So what we talk about is it's a 1% change, okay? Everything's in ones to keep everything equal. So a 1% change in this number going from 47.72 to 48.22, that increase will increase the price or these options by 3 cents. A decrease, vice versa, will decrease these options premiums by 3 cents. So in the next second, if this down tick to 47, all other things being equal, the market didn't change, these would decrease by 3 cents. So Vega is one of those Greeks that to me is one of the most important aspects to trading. Delta is very important when we're setting up our strategy, but we also need to be very mindful of the Vega, because theta, we'll get a ballpark as to where our theta numbers are going to be and where we want theta to lie. But Vega, we need to be very aware of when we're setting up a strategy. All right, so let me get on to a couple other things real quick, because last time I went over getting stuck on these slides. So long put spread is basically buying an in the money put or selling an out of the money put. Now this is what I'm talking about. You can go online and find this, and you can do the at the monies as well. If you're doing the at the money put though, to start out, you're buying the at the money put and then selling an out of the money put, you need to be really bearish, okay? You need this market to move rather quickly. I usually do it as an in the money put, and I'm picking about an 84 delta put to start with. That's in the money. And then this one that we're selling, especially if we're doing the in the money, the put that we're selling, we're trying to finance all of the extrinsic value of our options. So options have intrinsic value and extrinsic value. Intrinsic value is what this option is actually worth. So for instance, if we're looking at the 24 strike here, this is all extrinsic value because it's really worthless. And this is really all theta decay. So in the next 28 days, all else being equal, this would decay to zero. But these options that are in the money are the ones that I'm going to be looking at, and right around that 84 delta, so the 29, 28 and a half strikes. These have intrinsic value and extrinsic value. The intrinsic value tells you what it's worth. So for instance, let's just go for math to make it easy. If we look at the $3.60 premium, because that's mid-market, right? And we subtract $3.60 from 29, we take 29 minus $3.60, okay? That means the option is worth, actually, sorry, I got a little ahead of myself, $25.40. So that means there's about, the difference between 25 and 40 cents is 67 cents, or sorry, 27 cents in extrinsic value, okay? So we took these 29s, okay? We subtracted the mid-market from what that strike is, okay? That tells us what the option is worth, and then, or what that option's value is. So it's really, you're buying, or you're selling, in a sense, the stock at $25.40, but it's trading $25.67. So there's 27 cents in extrinsic value. Now that gets really confusing, right? Right off the bat, I'm probably like losing all of the new guys. They're like, oh my God, are you kidding me? What did he just say? Well, think of it this way. Intrinsic value is what this stock's worth. So really what this underlying's worth. So the difference between 25, sorry, I'm going to have to do this the other way. 29, another way to figure it out, minus the $25.67 means that $3.33 is what that strike is worth. Okay, now it's trading $3.60. So that difference is still 27 cents. We came out with the same number, right? 27 cents. But there's an easier way to do that, okay? And this is a floor trader hack for you guys. Basically, when you're looking at this as intrinsic and extrinsic value, what's it worth? Well, this corresponding call is all extrinsic value, right? We talked about that. That means it's all theta decay. Well, it also is the extrinsic value of the corresponding puts. Now, it's not always going to be exact, and you guys, it can be off by a nickel or something like that. But is that nickel really worth going through all this math and figuring out intrinsic and extrinsic value when you're trying to figure out, like doing a strategy, and you're going to spend that much time on one stock and then go to the next one because it doesn't work, and it's just way too much effort for that, and you guys have better things to be doing. So at the end of the day, look at this, come across, and that is your ballpark on your extrinsic value that you need, is embedded in this premium here. Okay, so that's a little floor trader hacks. Oh, that's something that some of you veteran traders may not know, and that can be a great takeaway because that's all I do all day long. I never do all that math. As a matter of fact, I kind of messed it up the first time and went through too many steps. Took the long road. But at the end of the day, just look straight across. That's extrinsic value. What did I say? It was, 37 cents or something, or what did I say? It was 27 cents. So that's pretty much mid-market here. I went pretty much mid-market here. 27 cents lands right in the middle there. So this is all extrinsic value. This is intrinsic, which is what that option is worth, plus extrinsic value of theta decay. And the easiest way to do is just go across and look at the corresponding call, or if you're doing calls, look at the corresponding puts. They both work the same way. And like I said, I'm going to be looking at the in the money. I like to buy these 84s because that's a one standard deviation move to one side. So I have basically an 85% chance picking one of these two, 85% chance of me being correct in this particular strategy at expiration, for it to be kind of like right around here. Excuse me. Okay, so on to the next one. It's also known as a debit put spread. We have to have, I mentioned this a couple times, a bearish assumption. You need to be pretty bearish in this. And we're always going to pay a premium, which is a good thing because you know what your risk is, right? Anytime you're paying a premium, you know your risk. And we want to avoid theta decay. Theta decay is the thief in the night that comes and steals your premium. So how do we avoid theta decay? Well, I'll talk about that here in a little bit. Volatility, we want it to expand. We'd like to see volatility expand going forward because that will help our in the money options also. That'll help this strategy work a little bit better. All right, so picking the right strikes. I mentioned this once before. We're looking at picking that 84 delta in the money put. If you guys want to pick an at the money put and then sell a further out of the money put to help finance some of that value, you're more than welcome to do that. I'm not going to say that's wrong. You just need to be even more bearish on this underlying, and you need to have that happen fast because when you're doing an at the money, there is very little intrinsic value involved. There's a lot of extrinsic value, which is that theta decay component. So just be aware of that. I like to pick the 84 delta. All right. All right, picking the right duration. So when we're talking about theta, this is a good chart to give anybody to look at for theta decay. It's just a visual representation on what theta does. The closer to expiration, you can see it gets very steep, almost vertical at the end, whereas way out in time, it's more horizontal. So it not only decays slower, those premiums decay slower, it allows us the time to be right. And with a low probability strategy, we want more time to be right. And I'm going to show you a way where you can get further out here and it really isn't going to hurt you. You're going to basically be paying about the same amount of premium even if you go further out. All right, picking the right environment. picking the right environment, we want low volatility because we'd like to see volatility expand. So with something like this, I like, below a 30 IV percent. And the IV percent is pretty simple to figure out, even if you're not on Thinkorswim. I have the IV over here, which does the math for me in a sense. And basically what you're doing is you're looking at where the current implied volatility is. It's 47, just to round it off. So the current IV is right here, 47. So now we have a numerator and a denominator. We're going to divide the sum of the numerator by the sum of the denominator. Numerator on top, denominator on bottom. So 47 minus 24, we get 23. So in the numerator, that sum ends up being 23. And then we divide that by the sum of the high, which is, what is that, 68 or something? 69 minus 23. So 69 minus, oh, that's 25, isn't it? Well, let's just 25. So in the numerator, we have 47 minus 25. So we have 22 in the numerator. And then in the denominator, we have 68 minus 25. So we have 43. So 43. So we have 22 divided by 43, and that's right around 50%, right? If you do the math. Okay, so if you don't have a way of figuring out implied volatility percent, that's one way to do it. You just put in implied volatility and do the math yourself. I don't have a shortcut for you there, but with Thinkorswim, you can basically just go down here as well. See, it's rounding it up to 50%. This gives you a more exact number over here that I've added to the watch list. And this is the most important thing I look at, you guys, when I'm doing a strategy. Like if I want to sell premium, I'm looking up here. And I'm not even looking at the stock at first. I basically will click, okay, what has the highest? And look at the charts, and flip down. Now, we're doing a put spread. So in determining what kind of strategy you are going to do, you need to know what the implied volatility percent is, which is that math I just went through. So, for instance, you're bearish in one of these stocks down here, and you look at it, you're like, oh, I'm bearish Kroger. Oh, it's got low implied volatility. Well, if it's a bearish market assumption, and I have super low implied volatility, I don't want to be selling premium in a situation like this. I need to be buying premium. I'm buying volatility in a sense. I'm buying the expansion in volatility. And you can see when volatility gets really low, it has a tendency to migrate back to the middle or the median. And when it gets really high, then it migrates back to the median again. So what we want to do is sell volatility when it's high and, in a sense, buy volatility when it's low. And that's, in a sense, what we're doing. So with a bearish assumption in Kroger, it's got low implied volatility. A bearish put spread probably fits the bill then. And there's other things to look at also that my other webinars will cover, but this is one of those where, let's see if the bearish put spread works. And we'll go over some examples here in a minute, but let me get through this stuff real quick. And picking the right underlying. What I mean by the right underlying is to have a tight bid ask. So any stock under $100, we've got Kroger here at 28 cents. In the option montage, we need to have these markets be on the nearest monthly, the ones that are closest to expiration, the nearest monthly, because the further you get out, the markets are going to get wider, and this rule of thumb isn't necessarily going to work with that. But if they have tight bid asks in the monthly that's nearest expiration, you can be assured to know that there's people in those back months that are in there playing. So anything under $100, the bid ask needs to be 10 cents or less. Now, if you really love the stock and it's like 11 cents wide or something like that, that's up to you. But know that those tight bid asks are created by volume and open interest. You can see there's a lot of open interest in Kroger. There was a lot of volume in there pretty much. On a slow day today, there's a lot of volume on these at the monies, okay? So what that means is that there's a lot of people in here trading. And if there's a lot of people in here trading, that means all of these people want to get in and get out at some point in time and are willing to give up an edge, just like when you put on a trade, right? you're going to probably not necessarily go on just the offer to sell an option or bid to buy an option. You're going to probably increase it a couple of ticks. You're willing to give up an edge. And then what happens is then somebody on the other side goes, well, I want to, give up a couple of pennies to get the trade, and they make a better offer. That's what makes the markets tick, right? That's free market price discovery, which is what everybody talks about. But if you're trading in something that is like, first thing that comes to mind is Croc, and I don't even remember what their symbol is. I think it's Crocs. It's actually it's a $10 stock, but it's close. I thought they were a little bit wider than that anymore. But you can see there's not a whole lot of volume going on in these months that are coming to expiration, and it is only a $10 stock, but 10 cents wide. So that's a little wide as well. But in another rule of thumb, any stock that's over $100, like for instance, Apple. Whoops. If we look at Apple as an example of a tight bid-ask market, my rule of thumb here is you move the decimal place 3 ticks to the left, and the bid-ask should be about 17, 18 cents. So 3 ticks, move the decimal 3 ticks to the left. That's how wide the bid-ask should be for any of those stocks that are over $100. A $1,000 stock, you move it 3 ticks to the left, and it should be a dollar, right? So as you can see, there's a lot more volume and open interest going on in Apple for sure. And when that happens, you see something like this, where we were looking at Crocs, a $10 stock, had 10-cent wide markets. These have 3-cent wide markets because there's so many people in here willing to give up an edge. So these are the ones that we want to get involved in, picking the right underlying. That's what I'm saying there. Don't go out there and start trading, especially if you're a newer trader, in a stock that has wide bid ask, because you have to give up so much edge to get in, and then you have to give up all that edge to get out. It's going to eat away at all your profit. And for instance, when we were talking about theta, we can look at this. If those markets are really wide, or actually if the market's tight like Apple, it's 5 cents wide, right? I only have, if I gave up a couple of pennies, if I sold this at, 91 cents, or if I bought this at 88 cents, right? One day goes by, that has only decayed by about 5 cents, 5 cents on the theta here. Okay. So I'm able to get out relatively closer to where I got in. If the market went down by what is a third, so 33 cents, it's going to increase, by about a nickel or 10 cents, I'd be able to get out for a profit, not taking into account your commissions. But at the end of the day, what I'm saying is this theta number is going to eat away at your premiums. And if you have to give up a lot of edge to get in to buy this, just think about how much you have to give up to get out of it, especially on like maybe 25, 30 cent wide markets. You're probably going to have to give up 10, 15, maybe even 20 cents to get in. You're going to bid all the way up there, and then to get out, if you're wrong, it's going to be really painful, because you're going to have to give up all that 20 cents edge that you gave up to get in, and then another 10, 20 cents to get out. It's going to eat you up. So make sure, especially as a newer trader, you're trading in something that has a lot of volume and open interest. And the two are pretty synonymous. Where you have a lot of volume and open interest, it means you have a lot of tight markets. Because all these people want to better the market in order to get filled first. Okay. All right, and know your exit strategy before entering the trade. Now, depending on how you trade, if you are looking at charts and stuff like that, and you're like, okay, well, it's up against this Fibonacci level, or it's up against the 200-day moving average, or it's a shooting star candle, something like that, right? And now you're looking to be bearish to the downside. Well, if you have a shooting star, if the market goes above that shooting star, generally speaking, that hasn't been confirmed, so a lot of people are going to want to get out, right? Well, then use that as your out on a loser. And if you have a market where you're like, okay, I think it's going down to the 50 Fibonacci level because it's bounced up against, the 78, and I think it's going to go down to the 50, well, then that may be where you want to get out of this strategy. But use that in and around this. Now, what I usually do is if I'm picking that at the money strike where I'm really bearish, I usually get out when my short put is tested because I know I've beaten the probabilities. And that's another thing that Delta tells you, right? Is that, and maybe you don't know this, but Delta tells you the probability of success. And this Delta tells you the probability of this strike being in the money, the 170 strike being in the money at expiration by 1 penny. That means that in 28 days, Apple, the probability of Apple trading $169.99 is 25% probability. Not a very good probability, right? The other thing that Delta tells you is probabilities of the 170 strike being tested or kissed in the next 28 days is 2 times the delta. So that's a floor trader hack where all of these are actually. A floor trader hack is something you won't find anywhere else. Also, you can find some of those other ones, but this one, the probability being kissed or whatnot, is 2 times the delta. So in the next 28 days, I have a 50% chance of Apple coming down to 170. Okay. So 2 times the delta is the probability of being kissed within the next 28 days. Delta tells you what the probability of this strike being in the money at expiration. Now, so that's a pretty low probability, right? So if the probabilities are that low, I'd rather go with the probability of being kissed to get out because that's a higher probability of success. Therefore, if I am picking the at the money and then picking one of these down here, say the 155s or even the 160s, the market coming down here, there's only a 7% probability I'm going to be in the money at expiration. There's only a 14% probability of me being kissed on this strike. Therefore, I know I've beaten the odds, right? I mean, it means you went to casino and put all your money on 0 at the roulette table and you got hit, you know? So I would walk away from the roulette table for the rest of the night if that happened. And same for this. That happened for me here. I'd get out as soon as I got tested on it. You are not going to get the max profit on this when that happens, but that's where I'm taking what I can get and I'm running with it. Okay. Now, if we choose the one that is in the money, so the 84 delta that I was talking about, we have an 84 delta right here, the 82 and a half. And I'm going to try and finance this strategy with the extrinsic value. So when I'm doing this strategy with the in the monies at the 84 delta, the important thing to find out is what is the extrinsic value? Well, that's what decays, right? That's theta. That's the thief that comes in the night and steals my money. So I know that there's 70, let's say 70 cents intrinsic value or extrinsic value of this option. So I need to finance that by selling a strike that's at least 70 cents, which would be this one. So I would be going and buying the 82 and a halves, and I wouldn't be doing it this close to the market or this close to expiration, right? We need to go out to the further expiration. So let's look for the 84 delta. It's kind of a pick 'em, all right, between these two. You might want to roll it down to the 81 so you don't pay as much. Look across. We got to finance $2.40. So we're going to be buying this one. $2.40 I got to finance. So I got to go to this one because I want to pay for more than the extrinsic value of that option. So now, in a sense, I'm doing this better than, I paid off even some of the intrinsic value. So I've decreased my risk even more by doing that. All right. Does that make sense for everybody on this one? Okay, so then the increase where I would want to get out when I'm doing the in the money one is I want a 33% increase in my premium, and that's where I'm looking to get out. A lot of times when I'm selling strategies, I look to get out at like 50% of max profit. This, I'm looking for this premium to increase by 33%. So the easiest way to figure that out is to punch it into the calculator before you even do the trade. $1.80, or sorry, 1880 times 1.33. That's the easiest way to figure it out. Okay, so when this is trading 25, I'm getting out. I'll talk about what the max profit on this is. 35. If these 60 puts were in the money at expiration by 1 penny, your max profit is $35. So yeah, I'm taking a lot less, $10 less than what my max profit potential is. But I know my probabilities are against me, so I'm willing to take less, right? It's kind of like if you have a bet on or something like that on the roulette table, and somebody was like, hey, before they spin this wheel, I'll give you your money plus 33% more if you don't let the wheel spin. I'd take it. I didn't even bet, right? I didn't even put money in it. I didn't risk anything. So in a sense, this is a low probability strategy, kind of like that roulette wheel. If somebody were to say, hey, I'll let you out of that right now, wouldn't you take it? Yeah, I would. But I also go for singles and doubles. I'm not going for home runs. So singles, doubles, and triples. I don't go for the home run. All right, so you're taking less than what your max profit potential is because the probabilities are pretty low. And I see a couple of people throwing out a question, so I'll try and answer them. In today's market, what do you prefer, long put diagonal or long call diagonal, and why? Thanks. Chuck, remind me to talk about that at the end there, and I'll talk about it. I want to talk about this for right now, but we can talk about it after I'm done. What are the alpha characters next to the bid and ask prices? The alpha character, the C's, the A's, the H, and all those are what exchange that bid is or offer is at. So I don't even know what I'm guessing the C is probably the CBOE, and maybe the NASDAQ or something like that. But basically, it just tells you where that bid is deriving from. It's basically coming from what exchange. Nice tactic to pay for the extrinsic value. Thank you, Kelly. And therefore, you don't have to worry about theta decay. When you pay for the extrinsic value, that's theta, right? So if we paid for theta, we've gotten rid of that component, that thief in the night that comes and steals our premium. So now all we've done is increased our time to be right, okay? And that's the important takeaway is here. You've increased your time to be right. And we could look at something like, let's look at these 56 days to expiration, and we look at basically those similar strikes. On this one, we're looking at the 95 puts, only to compare apples to apples. So we buy that. I got to pay for 87 cents in extrinsic value, so I pick those. And you can see, it's pretty close to what we were paying, if not a little bit more than what we were paying on this. We got a little bit more width out of it, but at the end of the day, it's pretty close. But you've got 50 more days to be right. And you don't have to worry about it decaying. You just have to worry about your directionality assumption being correct. Okay? That makes sense for everybody so far? When will you close the trade if it goes against you? Farshid, with this one, a lot of times on it going against me, for you guys, use what usually gets you out, right? For me, one thing I'm doing is with this strategy, I'm doing it very small. I'm basically doing it to keep me in the markets and to keep me active, right? I'm a very big proponent of trying to stay active in the markets every day. So I'm on my game in a sense. But having said that, I will a lot of times let this ride out. Now, for you guys, one thing maybe if the premium inflated was cut in half. So we paid $18 for this. It goes to $9. 50% loss in the premium value might be a good time for you to get out. A lot of times I'm doing this so small, I'm going to let it ride. I'm going to risk that. Does that make sense? And that's because I'm very bearish on that. Yeah, 50% loss in the premium you paid. So if you paid, $10, you're getting out at $5. If you paid 20, you're getting out at 10. But one thing I would say is that make sure you do this very small. If you're used to doing, if you haven't traded at all and you're doing this, do it as one lots. I don't care how big your account is to get your feet wet. Trade it with one lots. If you're used to trading, short strategies or something like that, if you're more of a veteran trader and you like to sell premium and you're thinking about adding some long deltas because, volatility is so low or whatever, or, you just never knew. Maybe you were selling premium when volatility was low and you're learning that you need really low volatility in order to buy them, and you would never sell premium when volatility is really low. But if you've learned that, having said that, then if you're used to doing 5, 10 lots selling option premium, I would still do this as like a 2 or a 4 lot maybe. As a matter of fact, when I'm doing a long put spread, I almost never go over like a 4 lot. Can't remember the last time I bought a long put spread that was a 5 lot. Okay, David, I answered your question. Cool. Do you ever lose the price of an underlying stock? Use the price of the underlying stock as your potential stop loss, i.e. Apple stock price hits a certain price, you are stopped out. Thanks. Yeah, and I don't use stops because I always say that my finger on my mouse is my stop because I'm pretty much in the markets quite a bit. But yes, for instance, maybe you use Fibonacci's and stuff like that. You throw these up, and I'm not going to try and be super accurate on this. Maybe off by a lot, I don't know. But for instance, here, so you could say, well, this whole area up here has been acting as resistance. Last time it got up there, it kind of fell out. It's just really having trouble getting up and through this area. And you're bearish on Apple. Okay, so for instance, I would buy that in the money option, but maybe I see it go above this Fibonacci level. That could be the point where I get out. It's up to you guys on your trading, how you come up with your assumption, right? And picking those locations. And now I say, well, when it comes down to 162, the 23 fib level, that's where I'm getting out. Or you could even look at this as, the next high because it came up to a top here. I use market profile, so I might say to the value area high, that's where I'm going to get out, things of that nature. So don't necessarily change your trading strategy to implement this particular options strategy, okay? If you're comfortable with using support resistance levels and different technical analysis to come up with your market assumption, continue with that. But to increase your probabilities of success with trading options, that's where I'm coming up with this, paying for the extrinsic value of these options and things of that nature. Because, all we did when we're doing this strategy here is we paid for what these things are really worth. We paid, the 195 puts, we got them for what their value is, because there's no real value necessarily in theta, and theta would kind of come off. Okay, Buck is asking, just got home, did you explain the criteria you use for determining whether a credit or a debit spread? Yes, anytime, ballpark, or a quick and fast recap, anytime we're selling premium for credit spreads, you want high volatility. That means above 50. Anytime I'm buying premium strategies, I want it below 50. And with this one, we talked about like the theta component and stuff like that, but volatility will help us when these options feel volatility increase, okay? So that is going to help us because these options are going to actually kind of inflate a little bit faster than these are. So especially on the put side. So you're going to feel that a little bit more, and it's going to help you, especially on the put spread. So we want low implied volatility in the hopes that it will expand. Okay. Quantitative option trading is often in conflict with technical trading, or at least that's what's been my experience. Farhead, I agree with you. I don't have the charts be the end all be all of my market assumption, but one thing I do look at this is the psychology of the market. And I told you guys that my major started out as psychology because this is telling you where people are putting their money where their mouth is, right? This is where people have entered the market. Okay, a lot of trades gone on here. That means a lot of volume has traded here. Now, what happens is a lot of time, this we called on the floor, the Stoudemire, the market gets overextended to the upside. Well, what do these guys do that bought it down here, right? They are looking to probably take some profits. They've had a nice run. And what happens is when they start taking profits and everything else, then it starts wanting to migrate back down to this area. So they're like magnets in a sense. So I do use the market profile more so than I look at like a shooting star candle and stuff like that or whatever. I will look at like gap retracements a lot of times, but come up with your market assumption on the underlying. And I also use economic information to determine my market direction and not even look at the technicals necessarily. If I can make my theory a little bit stronger, then of course I'll use all information going my way. One thing I want to express to you guys, and I think I failed to mention this, when you're building this strategy out, like I have at least five, I have five that I can count right now, spiral notebooks right next to me, right here on my desk. I write down every single trade I do, why I do it. If I say, it had this kind of formation, or I think it got a little overdone, or I saw, crude oil inventories rising, and I want to get shorts like USO or something. I write all that stuff down, all the information that I took in order to implement that strategy. And I suggest you guys do that as well, because, over time, you'll be a better trader for one, because you'll see like what things worked for you and what things didn't, but also write down exactly where your exit strategy is. If it breaks above, this Fibonacci level in Apple, I'm out. Because if you write that down, you're more likely to follow through with it than if you don't write it down. If you don't write it down, it gets above here and you're going to be like, well, I'm going to wait till it gets up to around, let's say $10 higher or something, and the market continues to go against you. And at the end of the day, you're going to kick yourself. I've seen a lot of people lose a lot of money by not sticking to their trading plan, by not writing it down. And I'm guilty of it too. I've done it before especially when I was a beginning trader. It was like, I knew the probabilities of what the interest rate increase was and things of that nature. And when I beat the probabilities, I'd say I'd get out. Well, probabilities went in my favor, and now I'm going to let it go a little bit further. And, that's usually when it comes back to spank you. So stick with that. Write it down. And, the next trade, maybe you say, well, I'm going to wait till it goes $5 above, and then, play with that. But stick with your game plan. I can't express that enough. When you say you're going to get out of the level, get out of the level. Do it. You'll sleep better at night staying mechanical, and you'll be a much better trader. Because the only time, and I'd never look back either, the only time you're necessarily going to look at it and say, oh, you're only going to remember the ones where, God, if I would have stayed in that, I would have done a lot better. You're not going to look at those ones where you're just going to kind of breeze by the ones that, well, I got out and I was right to get out. You don't really have a tendency to stick with that. And of course, I've gotten into talking way too long for this webinar, and we're going to go over, I guess. Max profit is the long strike, long put, minus the short put. So basically it's the width of the spread minus the premium that we paid for it. So when we can look at something like that Apple trade, hopefully it's still up, we can figure all that out. So let's go into the trade window. So we got this Apple trade up. And yes, I would normally go further out. I'm probably going to go to that 100 strike if I were to implement this strategy. But because we have it up, we have a $40 wide spread here. Okay, it's $40 wide. We pay $19. So our max profit is the width of the spread minus the debit paid. Okay, so that width of the spread minus the debit paid is going to be, our max profit would be $20.19, right? So our max profit is $20.19. Our max loss is the premium paid. Anytime you're doing a debit spread, it's that premium you paid. So the most I can lose is that $19.81. So the max loss is the premium paid. And where's our break even? Our break even is that long put strike minus the net premium. So to figure that out, we need to pull up that chart again, or pull this up again. So let's just call it $20. So it's the long put, then $19.95 minus $20. So when this underlying is trading at 175, that's our break even. And generally speaking, it is going to be right where the underlying is trading, right? So if it stayed right here, right now, at expiration, we would be at a break even. Why is that our break even? Why do we even want that to be our break even right there at the last? Well, because we want it to, we would like it to be a little bit higher because that means we paid for more of the intrinsic value by selling these. Okay, but we pretty much, if we went mid-market on that or something like that, we would be better by a couple of pennies because we paid a couple of pennies. We got paid a couple of pennies extra for selling these puts. But it's generally going to land right around where the underlying is trading because all we're trying to do is pay for this theta component. Does that make sense for everybody? So since we paid for the theta component, we paid what these options are worth, which is really important. Okay? And another rule of thumb I have with this is try and pay like less than, right around 50% the width of those, the width of the spread. Doesn't always work, but that's your goal in this particular strategy is to pay the width of 50% the width of the spread. Okay, so this is usually where I throw it out to you guys. Throw out a couple of stock prices or stocks symbols, and we will go over that. All right. David's asking, when you buy spreads, you want max 30%, 30 IV percent, correct? And when you sell spreads, minimum of 50 IV. Yes, David, that's exactly right. That's exactly right. All right. So do you guys want me to go over a couple other examples besides Apple? Apple's a pretty good example, except for the fact that it has pretty high implied volatility. So I would kind of stroll down here and look at something that's that I'd be bearish in. Are we bearish in the retail sector? If you're bearish in the retail sector and you think Amazon's taking over the world, then you might be bearish in the retail sector. So it's at pretty high. I mean, a lot of people have been talking about people going to the malls actually and getting out. So they might do that. Rick wants to look at UNG. All right, nat gas. All right, well, you're in the winter time. We had a bigger than expected drawdown in nat gas, but I don't have a problem with that. If you're bearish in nat gas, you're not going. This could be a tough one to do, but it has an IV percent close to 50. It looks like. So let's hit the trade window. Let's close all these other ones out. Go pretty far out. It's got a 51 IV percent. I'd like to get it below 30. in order to do this. But it'd be up to you. I'd probably wait for the volatility to come out. Are you teaching debit diagonal or credit diagonal spread? Sorry, confused. Chuck, we're doing just, it's not a diagonal. Diagonal would be if I was doing 2 different months. What we're doing is just a put spread. So it's a vertical in a sense rather than a horizontal. Horizontal is going out through months. So we're doing a vertical put spread, 1 month, one expiration in this. Okay, I will be doing the debit diagonal and the credit diagonal shortly, though, or not shortly today, but in the near future. All right, so let's just look at that what I was looking at, retail, because I'm kind of bearish on the retailers. So let's just look at XRT. It's had a nice big run. We could say that it's looking ready for a pullback. It's got really low implied volatility. It's even got low implied volatility if you take out those 2 spikes. And we look at the trade window, kind of go out 84. I don't really want to go 175 days because I'm going to pay a lot. But so let's look at the 84 delta. Where do we get that 84 delta? Right here at the 50 strike. So I'm going to want to buy these. And remember, the ones that we're looking at to have tight bid ask are the ones that are near just out of the money, but also look at these markets that are the closest to expiration to determine that rule of thumb on how wide the market should be. Because if you look at it, near expiration is going to have a lot of volume and open interest in it, but the ones further back are probably not going to have as much. It still is pretty good though. So, and over here. So what we would do is look at these 50 strikes, and I'm going to buy those, right? So then I'm going to look across. How much do I have to pay for? So at least 30 cents. So I need to sell the one that has at least 30 cents. Probably go with that one there. Why didn't you give it to me? All right. So $5 we're paying for this, and it is a what is that? A $10, $11 wide spread. We're paying less than 50% the width of the strike. That's good. That makes that work. And we would need to be bearish on this. So we're paying $5 and determine what you would say is your out. It's going to be up to you guys. $50 is going to be a new high. That might be your pick. I think I've got the expansion on there, but that could be it. Determine that. I'm probably going to, with something like this, I'm probably going to do it as like a 3 lot and let it ride. That's me though. I have a high tolerance for risk, you guys. So my tolerance for risk is much bigger than yours. If you have a low tolerance for risk, maybe when this decays by 50%, which isn't going to even go, all the way to the 50 before it decays by that much probably, but a 50% decay in that, you could look at that as well. But I'm going to be looking to get out as soon as this market goes down and trades 39. Okay, that's where I personally would look to get out. And the reason why, those 39s are probably going to be about a 10 delta. Yeah, 10 delta. So that means I only have a 20% probability of this strike being in the money at expiration. So I would look to either have that get hit, kissed, because I have a higher probability of success, or the other thing, because I'm picking the one that is in the money, I'm most likely going to go with this one, is the $5 times the 1.33, because that's a 33% increase in the value of my premium. I rounded it up. I always round everything up. Equals, when it's trading $6.65 is where I'm going to write down on my piece of paper why I did the trade, where I'm looking to get out. Okay. Do you consider the liquidity of these options? The spread is high there. I do consider it. But remember, my rule of thumb on the liquidity on this particular strategy is really going to be determined by the, I look at the liquidity in these front months. Because by the time I get out of this strategy, the liquidity is probably going to have started rolling. We used to call it the roll. People are going to roll out of those and into the further duration, and they're going to start buying and trading these. And then there's going to be diagonal spreads, like Chuck mentioned, that are going to start like hitting off and adding more volume and open interest back here. So that market will have a tendency to get a little bit tighter as time goes on. So, and that's really what we're looking for, is if there's a lot of players in here, you can be sure the guys that have volume and open interest in these near expiration months are probably still keeping an eye on these out here. And they see one of us coming in and bettering the market, they might come in and offer a better market. Okay. Stava, I think. Yeah, Stava or Slava, sorry. How long do you hold the debit spread normally? I would normally hold these until I'm right, to be quite honest. So until I meet my exit strategy. So it could be in a matter of days. If I put this strategy on, let's say, for instance, I do have time stops in a sense where I'll get out earlier than what my max profit potential or what I'll get out earlier. I won't usually get out later, right? I won't let this continue to run when I've gone above this number. But if it's below this number and it's run down, say for instance, I put this strategy on Monday, okay? And by Wednesday, it's already down there trading, and I'm probably going to cover it for whatever I can get, okay? Because I've beaten the probabilities. I'm most likely not going to get this increase necessarily. I may get close to it, and I'll look to cover it. Okay, so I always want to get in and out of strategies fast as I can. And if I've beaten the probabilities, and in that case, I would have like crushed the probabilities, then I'm going to look to get out a little bit earlier. Why would you not sell the strike with a higher delta to improve your probability of success or decrease your cost? Kelly, you can, but when you're selling that higher one, you're also decreasing the width of the spread. So it will have a tendency to not allow this premium to increase as much. Because remember, it'll reach there faster. You can do that, but you're also going to be paying probably more than 50% the width of the strikes too. So, but you can do that. Say for instance, what Kelly's saying is, why not, if there's only 30 IV percent here and, 30 IV percent, 30 extrinsic value, why sell these 30s, 39s? Why not go up here and sell them a little bit higher, or even the 41s, or the 40s, to increase the probabilities of success? Because Kelly very wittingly, very smart, realized that, well, there's only a 20% probability or a 10% probability of success for this to be in the money one. This is 5 percentage points better. And as a matter of fact, it's 10 percentage points better that I'll get tested on that. You can do that, but note that it has a tendency to not, because you want these to decay kind of worthless, really. You want these to decay more, and that allows that to happen. If the tighter you are, the less probability you're going to get those to decay a lot, right? When it's moving in your direction. Does that make sense? You are increasing your probability of success, but you got to remember that we want this premium to decay, because this premium decaying is paid for the extrinsic value. Okay. Does anybody else have anything else? Cool. Well, that's about it, you guys. In the chat window, I've got a link sent out to you guys that talks about this options course. It's basically options course, how to trade options like the Wolfman, how to set up your screen like I have with the implied volatility percent, with the market profile, how to even trade your market, profile, how to trade options using gamma, things of that nature. We didn't really talk about how to trade options using gamma, but I talk about that in there. History of options, which is a fun one, using market profile to trade options. I go in more detail about that. I mean, I talk about in all of my classes, you guys, increasing probabilities. And Kelly noted, why wouldn't you increase your probabilities? Well, there's yin and yang to that, right? So I teach how to trade probabilities and how to increase those probabilities, because especially with like a long put spread, it is a low probability strategy. So if you think that you guys have learned anything, especially if you're one of my regulars, if you've enjoyed my instruction, you guys should take advantage of this. There's a couple of really fun ones in here on the history of options. And more importantly, this is a huge one. Fed just increased interest rates again. How to protect your portfolio against rising interest rates. This rise is very, very important and probably worth $36 in and of itself, because rising interest rates is going to decimate a bond portfolio. Yeah, if you hold it for 30 years, you're going to get the value back. But if you have like an ETF or something like that, where your maybe financial advisor put that in there, or you have them in your 401k, those values, because those guys are going to be chasing yield. You can't chase yield and make money in a rising interest rate market. It does not work. The value of those bonds goes down faster than the increase in coupon or the payment you receive happens, and it will go down in value. So the only way to offset that is with some options. All right, and how to calculate the cost of an options and stuff like that. So take advantage of this, you guys. I mean, if you're trading with technicals or building strategies, kind of like I think it was David mentioned, or somebody mentioned earlier on about the trading with technical analysis isn't the best way to trade. I agree with that because I want to trade with the probabilities. So what I mean is I teach all of that, how to play the probabilities. When the probabilities have gone against us, how we stay mechanical and increase those probabilities even further. When you're trading with the right tools in the right situation, you're more productive state of mind, and you put on more strategies, which increases your probabilities of success. You might put on this strategy today, or actually you can't put it on today, on Monday or Tuesday, and it goes against you. Well, it doesn't mean that it's always going to not work out. It's going to mean that it's probably not going to work out more times than not, because it's a debit spread. But anytime you're trading with probabilities, just hold solace in knowing if it bites you, that the probabilities kind of went against you, and the next time they're more in your favor. All right. So we're offering this trial to you guys today. I suggest you take advantage of it. What do you say? Go ahead and click on that link right there in the chat window. I sent it out to everybody. And you guys should be trading with this knowledge. Seriously, especially give yourself a Christmas gift or a holiday gift. Thank you guys. Happy holidays. That's all I got for you guys. If you can't take that, take it easy. Thanks, Farhad. Appreciate it.